Welcome back to Finance for Firefighters. Today we're going to talk about some stuff related to the new One Big Beautiful Bill, the new tax that just passed by President Trump, talking about some different implications related to us in personal finance. And today's topic is going to be about overtime exemption on federal taxes. No federal taxes on overtime. So one of the biggest benefits of this bill is that from the year 2025 to up to 2028, the next 4 years, we have the ability to deduct up to $25,000 of overtime that you would normally be paying federal taxes on. For the next 4 years, you're not going to have to pay federal taxes on that $25,000 worth of overtime, which obviously means more money in your pocket right now. Before you sign up for overtime, think ahead about it, right? Work smarter, not harder. Write down exactly what you're going to be planning on spending that money on. If you have the ability to have no taxes paid on this over the next 4 years, it's a really good idea to start having some good conceptual ideas and good strategies about what you're going to be spending that money on. This would be like showing up to a veg fire and having an unlimited water supply. If you waste that water spraying on stuff that's not going to be put in the fire, obviously you're not really helping anything, right? But if you are using that unlimited water supply to be able to put the fire right away, you're going to limit spread and loss of structures and stuff for a veg fire, right? Same thing with this. If you don't plan ahead and you're not planning on where you're going to be putting that overtime money, you're going to be wasting this opportunity that we have for the next couple of years. So let's look at a comparison between what we have in the next 4 years and what we had previously. So for the old overtime system, depending on your withholdings, 22 to 35, 37% would get taxed federally. And now for the next 4 years, depending on your filing status, if you're single, 12,500, if you're married filing jointly, up to 25,000 is now federally tax-free from the year 2025 up to 2028. Old versus new. Less overtime, obviously, less money in your pocket. Now with the new system, more money in your pocket, more ability to save, more ability to invest. Quick note, so there are income levels for this. If you're single, it's up to $150,000. If you're married filing jointly, it's up to $300,000. So you need to be able to make sure your income level stays below these things before that money starts getting phased out for what your federal exemptions are on those taxes. Here's a couple of things you can do to do that. You can lower your adjusted gross income by doing several different things. Number one, max out your 457. Number two, you could contribute more to your HSA. Number three, use flex spending accounts. For qualified medical expenses, you do this once a year. Number four, check with payroll and see what other contributions that you or deductions that you have that come out that reduce your taxable income. This includes things like food money and union dues. Think of it like pulling ceiling during attic fire, right? If you're pulling the ceiling during that time and you're able to get water in there, you're going to be lowering the amount of heat that's up there that's going to be able to help effectively put that out, right? So if you look at your adjusted gross income in the same way, if you're able to reduce that, you're basically keeping it in check and you're staying below that level so that you do qualify for those benefits. Let's talk about some decisions you can make. So things you shouldn't do. You shouldn't allow lifestyle creep, trucks, boats, extra stuff that you don't need, and just wasting this opportunity you have for the next 4 years. Things that you should do are increase your 457 contributions, maybe put more into your kid's 529 plan, maybe pay down your home, pay off an auto, pay off debt that you have. If you work towards that and don't lose the opportunity now, you're really going to be able to push yourself ahead. So let's use an example. Let's say that you worked $20,000 worth of overtime for this year, right? For the next few years doing this, 4 to 5 grand of that would be taxed right off the top, depending on your withholdings and things like that. Moving forward, you're not going to have to pay any federal taxes on this. So that'd be like going on a strike team and having all of it come right to your pocket tax-free.
Right now, we're going to take a look at a little example of what you could do with that money if you decided to invest it and kind of run the numbers on what that would actually end up being in the long term. So let's say that you made about $5,000 a year extra without the federal tax on it. We're going to round it down a little bit and just say it ends up being about $4,800 for the year, so we'll say $400 a month you're able to do it. And then you're going to put it in there, you're going to let it invest for the next 4 years, and then you're going to get a 7% rate of return. Calculate that. So 21 grand is how much you're going to have in there with a short period of time over the next 4 years, which doesn't seem like a lot, right? The interest hasn't gone up that much because the time hasn't gone there, right? But let's run it out and see what that'll actually do for you in the long term, okay? So we had the 4-year opportunity, and then now it's gone, right? But if you had done it, you had planned ahead, and you put that 21 grand in there. If we run it out for another 20 years, that money just stayed in there and got invested. We're not doing any more monthly contributions, but we have this 21 grand. So we're saying we're fast forwarding to 2028, and we say we have 21 grand that's in that account. It's still invested, and we're going to leave it alone for 20 years. What's that going to do for us? It ends up being $81,000, right? So 21 grand went up by over $60,000. if we do the same thing for the end of your career, let's look at what that'll turn into. 160 grand. So if you did it, if you're a new person, you do it early now, just by reallocating that overtime savings you get from federal taxes, you'd have an extra $160,000 in a brokerage account. If you invest it, it's something relatively conservative at 7%.
We've all seen that guy that works 1,200 hours of overtime and he still says he's broke. That's when you use money, overtime money, like spending money, instead of using it to build wealth and pay off debt and launch yourself ahead. 5 practical steps to make the most of this opportunity we have for the next 4 years. So every year, January 1st, start tracking your overtime and see exactly how much you're working. Number 2, track your amount of total income to make sure that you're staying below those phase-out limits. Number 3, build a 4-year plan. You got from 2025 to 2028. Find out what you're going to do to build wealth and put yourself in a better spot financially. Number 4, use that money for smart moves. Max out your 457, put more to your kids' 529 plans, pay off debt, invest that money. Number 5, make sure you meet with a tax pro to make sure you're doing everything correctly. Remember, this is a 4-year window, right? Don't waste the opportunity that you have for the next 4 years to make the most of overtime. If you have the ability to work the overtime, you have the means and the availability between childcare and things like that, work it, but don't just work it. Work it with a plan. Have an idea of what you're going to be doing with those funds. This is a once-in-a-career opportunity to be able to help springshot yourself forward and make a big difference in your financial status. Download the OT Wealth Plan worksheet. There's a link in the description. Click and subscribe to get more tips for finance for firefighters, by firefighters for firefighters.